Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
People don't want advice. They want confirmation. I don't make jokes. I just watch the government and report the facts. Will Rogers. If you think nobody cares if you're alive, try missing a couple of payments. It's even right. Politicians say they're for the little guy, but they always seem to know a lot of big guys. The trouble with having an open mind is that people insist on coming along and trying to put things in it.
States are quietly swapping concrete for cash. Unconditional transfers feel good today, but they squeeze out Capex that actually builds tomorrow. Roads, power, factories and jobs. The chart says it plainly. Total spend stays flattish, but the mix drifts towards non-productive outlays while growth Capex gets elbowed aside. The result? Weaker revenue balances, higher borrowing costs, and fiscal credibility taking a slow leak. Welfare isn't the villain, scale and timing are. When giveaways become permanent and assets become optional, growth pays the bill later, with interest. India's equity market is quietly deconcentrating. As retail liquidity deepens, mid and small caps are no longer side characters, they are taking real screen time. Large caps still matter, but leadership is spreading beyond the Nifty 50, diluting single stock rise and improving market depth. This is not froth alone, it's access. More participants, more capital flexibility, and more sectors getting priced in. The risk? Liquidity giveth and liquidity taketh away. But structurally, this is how markets mature. China is not storming the dollar's castle, but is quietly building side roads. The People's Bank of China has signed $650 billion worth of local currency swap lines with 32 countries. There's liquidity without the dollar pit stop, trade without FX headaches, and influence without fireworks. This isn't regime change, it's optionality. The dollar stays king for now, but Beijing is pricing in a world where alternatives exist. Slow, patient, and very Chinese. As Sun Tzu said, the supreme art of war is to subdue the enemy without fighting. India's growth story looks fantastic if you own things. From 2020 to 2026, gold is up over 300%, real estate in Gurgaon up 130%, and equities are up 100%. Now flip the page. IT fresher salaries plus 11%, IAS salaries plus 38%. Meanwhile, rents, flights, healthcare, and coffee all ran faster than inflation and much faster than pay hikes. The bottom line, India did not just grow, it financialized assets printed, incomes jogged. And the middle class is paying EMIs for a marathon it never signed up for. Yes, India's total external debt is $746 billion. Sounds scary until you read the fine print. Over 95% of government debt is domestic. Foreigners own less than 5%, and a chunk of that is rupee denominated, meaning no dollar panic, no FX ambush. Most of the external debt sits with corporates and NRI deposits and not with sovereigns. And at 20% of GDP, India's external debt ratio is boringly stable, especially compared to countries that borrow like it's Black Friday. India's 53% credit to GDP does not scream credit boom, it whispers under-penetration. But copying the US won't help. America's low ratio works because bond markets do the heavy lifting. India does not have that luxury yet. So do we need more banks? Not really. India already has too many balance sheets chasing the same low-risk borrowers. PSU banks playing defensive, private banks clustering around the same AAA names. The real gap isn't the number of banks, it's risk appetite plus distribution.